bond yields have moved a lot already, right? If you start at the start of the end of the year, I heard you talk about the 10-year, they were below 1, now they're 1.6, 1.7. That's roughly 80 basis points. A lot of this has been actually through the real yield. So there is an expectation in here for better growth in the future. So that, in principle, we think it's a good thing. And the question is, of course, how much inflation will we get going forward? And we will get a lot in the next few months. That's for sure. We see year-on-year inflation going up. But when we look at things, we think this will mostly be a transitory phenomenon. And with inflation, in particular the U.S. PCE inflation coming down again towards the end of the year, we think we're in a pretty good spot where the Fed probably won't move for a long time, probably not until after 23 or end of 23. And we believe that remains, combined with the growth numbers that you just mentioned, actually a quite favorable environment for growth assets, in particular stocks.
What are the problems with the analysis? And I mean, we're all doing it at the moment, Christian. If we have a temporary phase of cost push inflation running hot through the summer here, why aren't workers going to insist that they get an increase in their salaries to reflect growing inflation expectations? We talk as though we can have a clinical rise in cost push that will then wash out towards the end of the year. Ultimately, that surely will crimp growth because it will have a direct impact on household incomes unless workers turn around and say, well, I need to be compensated to reflect the higher purchase prices.
Yeah, I think if we look at labor markets, they simply no longer work the way they did, and in particular not the way they did in the 70s. Obviously we're now reaching growth numbers where we think, wow, that does remind us of a few decades ago. But the way labor markets work, if you think about it, we had a 3.6% unemployment in the U.S. Before we went into COVID, and the Fed was still cutting. Because there was not a sufficient wage growth or the kind of growth in prices that the Fed would consider would bring it towards its target. And we can, of course, not fully know how this post-COVID economy reacts. To be frank, there's more uncertainty. But if you don't think that some of the phenomenon of technology, etc., the kind of impact they had, the way labor market functions, we just doubt that this temporary boost in prices will immediately lead to wage pressures that would then be more sustaining cost pressures. And one thing to say, by the way, there's a lot of excess savings not with every worker, but if you look at the accounts of households, we estimate in the U.S. Up to 10% of excess savings having accumulated in deposits. And, so there's a lot of spending power by households in aggregate, at least, I would say. And so, that may also alleviate a little bit the immediate pressure people have on higher wages.
But Christian, you have a brilliant resume of education and experience as well, from the IMF to Cologne, where you did your doctorate, and all these places. At all these places, you would have had at the back of your mind the original part of economics, which was supply and demand. So regardless of what we think about inflation, if supply of bonds is going to be excessive going forward, which I think all indicators are that they are, having just passed 1.9 trillion in the States and a 3 trillion coming down the road in terms of infrastructure, a lot of that isn't going to be paid for by economic growth. It's going to be paid for by new and excessive debt in many cases across the world. Surely that alone, regardless of what we think of inflation, means that we are going to see higher yields. If supply gets higher, then the buyer is just going to hold off a little bit and wait for those better yields.
Well, I think we will certainly have a bit of it. And we are seeing it now. And you mentioned some of the auctions that are more difficult. We would say overall, though, in the past few years, I heard this a lot, and then clients would say, well, supply, demand, when this tapering started. And there was a lot always to talk about supply and demand. But ultimately, if we think of the longer-term yield curve as a risk premium, one part, and the other part being, the implied path for short-term rates, which is effectively the Fed rate path, as long as people do not see necessarily inflation running away and the Fed having really to do a lot of hikes, we think that element is really what mainly affects the yield curve. We can add a few, bit of risk premium on the term premium, for fiscal risk, and supply and demand, certainly, and risk premium has been very low. But, the question is, what orders of magnitude do we talk? And we do think that if a significant infrastructure bill was to come, 1 to 2 trillion or so, with that alone would add, let's say 50 basis points or so to the long-term treasuries. Otherwise we tend to not to overemphasize the supply-demand argument.